Small cap value. Some call it the secret sauce for higher returns, others say it's just a dead premium. Is it worth the tilt or just added noise? In today's episode, we're breaking down the case for and against small cap value funds.
This is the LawyerFI Podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to the LawyerFI Podcast. I'm Adam B. Cordover, your host, helping to equip lawyers and other professionals with the tools for reaching financial independence. Small cap value is one of those investing strategies that looks straightforward on paper, but in practice, it can be one of the toughest to stick with. It's also one of the most hotly debated topics in the investing world. Some investors see it as the secret sauce for higher long-term returns, while others argue it is unnecessary complexity that may no longer deliver on its promise. Two of the biggest voices on opposite sides of the debate are Paul Merriman and Ferri. Merriman is a longtime advocate for adding small cap value, calling it one of the most powerful long-term boosters available. He founded Merriman Wealth Management, later launched the Merriman Financial Education Foundation, and has devoted his career to teaching ordinary investors how to build disciplined portfolios. On the other hand, Ferri, a respected advisor and former president of the John C. Bogle Center for Financial Literacy, which, by the way, is the nonprofit that supports the Bogleheads community, argues that investors are better off keeping things simple, sticking with total stock market index funds, and avoiding the added costs and volatility of factor tilts. So, why should lawyers and other high earners care about this debate? Because, just like in the courtroom, investing often has two strong sides making their case, and small cap value forces us to wrestle with some of the most important questions in finance. Do higher risks really lead to higher returns? Or does added complexity just make it harder to stick with your plan? Imagine holding a fund that underperforms the S&P 500 for a decade straight. Would you stay the course or would you bail? That's the challenge small cap value brings. In this episode, we'll break down what small cap value actually is, why Paul Merriman champions it, why skeptics like Ferri and J.L. Collins urge caution, and what this all means for your journey to financial independence. When we talk about small cap value, we're really combining two different ideas: size and style. First, size. Small cap stands for small market capitalization. Market capitalization is simply the total value of a company's shares. In other words, the stock price multiplied by the number of shares outstanding. Large caps are the big names like Apple and Microsoft, worth trillions of dollars. Small caps, on the other hand, are much smaller publicly traded businesses, often worth a few hundred million to a couple $1 billion. Second, style. Value stocks are companies that look inexpensive compared to fundamentals like earnings, sales, or book value. These are companies trading at lower price to earnings or price to book ratios than the market average. Growth stocks, by contrast, tend to be the ones everybody is excited about, with higher valuations and faster revenue growth. So when we put this together, small cap value refers to companies that are both relatively small and relatively cheap. Historically, academics like Eugene Fama and Kenneth French have shown that small stocks and value stocks each outperform the broad market over long horizons. That's why they introduced the famous three-factor model, which added size and value to the traditional market factor. Why would anybody want to own companies that look boring or even struggling? Because history shows they've often rewarded patient investors. Of course, the ride isn't smooth. Small cap value stocks tend to be more volatile than the total market. They swing higher in good times and lower in bad times, which makes them emotionally tough to hold. Think of it like a lawyer taking on riskier cases. The stakes are higher, the stress is greater, but if you win, the payout can be more rewarding. That's the trade off of small cap value. Bigger swings, but with the potential for long term reward. With that foundation in place, let's look at why Paul Merriman has been such a passionate advocate for adding small cap value to a portfolio. Merriman has spent decades teaching everyday investors how to build portfolios that are both diversified and disciplined. After founding and later retiring from an advisory firm, he created the Merriman Financial Education Foundation, which offers free articles, podcasts, and model portfolios. And by the way, you can find a link to that foundation in the show notes. His message about small cap value has stayed remarkably consistent. If you want a reasonable shot at higher long term returns, consider tilting a slice of your portfolio towards smaller, cheaper companies, and then commit to holding them for the long haul. Why the conviction? First, the academic evidence. Building on the Fama French research, Merriman points to the historical size and value premiums, meaning a performance that beats the general stock market, that appears over many long samples. Second, the philosophy. He doesn't frame this as an attempt to do better than the stock market in the short run. Instead, he presents small cap value as a probability play. Tilt towards the factors that have historically paid off, and then let time do the heavy lifting. Third, implementation matters. Merriman's team publishes best in class ETF lists that are intended to capture deeper exposure to the factors investors are targeting. In the small cap value slot, a popular choice is Avantis's US small cap value, ticker symbol AVUV, which screens for smaller companies with strong value characteristics and quality tilts. It charges a modest fee for that sharper exposure, and unlike in the past where you could only get such a fund through an advisor, it's available as an ETF that can be purchased through Vanguard, Charles Schwab, Fidelity, or other brokerages. Here's how this can play out in practice. Instead of replacing your entire US stock allocation, you can carve out a slice, for example, around 10% of your equity bucket, and dedicate it to small cap value. The remaining 90% might sit in a total market index or a combination of other index funds. The goal isn't to outguess the market year to year, it's to slightly shift the portfolio's long run characteristics towards areas that have historically shown a premium. Merriman would be the first to acknowledge that nothing is guaranteed. Factor premiums can shrink or even disappear for long stretches. That's why his emphasis on education, expectations, and staying the course is as central as the fund selection itself. For all of Paul Merriman's enthusiasm about small cap value, there's an equally strong camp of skeptics. One of the most vocal is Rick Ferri. Ferri is a longtime financial advisor, a prolific writer, and a champion of index fund simplicity. If Merriman is like the prosecutor laying out evidence for the small cap value premium, Ferri plays the role of the defense attorney for simple index funds. His opening statement is clear. The evidence is old, and the market has already adjusted. Once investors catch on to a strategy like adding small cap value to boost returns, he argues, the extra return that once existed may fade away. In his words, just because something worked in the past doesn't mean it will work in the future. His second point is about cost. Funds that lean harder into small cap value often charge higher fees than a total market index fund. And the higher cost of most small cap value funds is really the only thing that's guaranteed. On paper, the difference may look tiny, say a quarter of a percent. But Ferry reminds us that over 30 or 40 years, those small percentages compound into larger dollar amounts. For him, every extra cost makes it less likely that investors will come out ahead. And then there's behavior. Tilting towards small cap value requires patience during long stretches when the strategy lags. Ferry worries most investors will give up before the payoff arrives. In his view, it's better to remove the temptation altogether by just sticking with the broader market. By the way, Merriman and Ferry had a great debate on small cap value and factor tilting on an episode of the White Coat Investor podcast, a link for which you can find in the show notes. This is also where J.L. Collins, author of The Simple Path to Wealth, takes the stand. Collins doesn't debate the data. He simply tells investors to avoid complexity entirely. His prescription is a one or two fund portfolio, a total U.S. stock market index fund paired with a bond index fund. Keep it simple, keep it boring, and he says you'll do just fine. You can learn more about his philosophy in episode 25-003 of the LawyerFI Podcast, where we dive into U.S. total stock market index funds. So on one side of the courtroom, you've got Merriman making the case for small cap value. On the other side, Ferri and Collins insists simplicity is the only reliable verdict. So let's look at the practical side. If you do decide to explore a small cap value fund, what are some of the fund choices? Vanguard offers both a mutual fund, VSIAX, and an ETF, VBR, that tracks small cap value indexes. As of 2025, the ETF charges an expense ratio of just 0.07 annually, which means $7 for every $10,000 invested. It's cheap, broad, and easy to find, but as Paul Merriman argues, its tilt is relatively shallow. This means there are other funds that give better exposure to small cap and value companies. Dimensional funds, or DFA, built its reputation on capturing size and value factors, with Eugene Fama and Kenneth French as early partners. The U.S. Small Cap Value ETF, DFSV, charges 0.30 expense ratio and aims for deeper factor exposure. Avantis has AVUV with an expense ratio of 0.25, and it tilts more sharply than Vanguard and is featured on Merriman's best in class list. I personally use AVUV for about 20% of my portfolio. Avantis also has AVUS with an expense ratio of 0.15%, which can be thought of as a total market replacement, as it also includes those companies in the S&P 500, but it is more highly tilted to small cap and value stocks than a U.S. total stock market index fund. If you hold AVS, you don't also need AVUV on top of it. Merriman also champions what he calls the two funds for life portfolio. This combines a target date retirement fund with a small cap value fund. Merriman's rule of thumb for this portfolio multiplies your age times 1.5 as the percent you would invest in a target date fund. The rest he suggests investing in a small cap value fund. So, for example, for a 50-year-old lawyer, 75% would be in a target date fund and 25% would be in a small cap value fund. This approach may be helpful for those seeking suggested guidelines. And we will be diving more into target date funds in an upcoming episode. If you choose to tilt towards small cap value, the real challenge isn't buying the fund, it's holding on to it. Compared to a U.S. total stock market index fund, small cap value funds swing more sharply. When the market is rising, they often surge higher. When the markets fall, they usually fall harder, although there isn't a perfect correlation there. And historically, small cap value funds have had standard deviation several points higher than total market funds. That extra risk is the cost of admissions for the possibility of higher long term returns. The key word here is possibility. Even though historical data show a premium for small cap value, there are long stretches when it lags. The most recent example was the 2010s, when large growth companies like Apple, Microsoft, and Amazon dominated. During that decade, small cap value underperformed significantly, testing the patience of anyone who tilted toward it. But cycles can turn. Since late 2020, small cap value has experienced periods of strong rebounds, especially when market leadership broadened beyond big tech. Merriman emphasizes that you can't judge small cap value on a 5 or even a 10-year scale. He often talks about 15 to 40-year horizons because it takes that kind of time for the historical premiums to show up with consistency. Imagine holding a fund that trails the S&P 500 for a decade straight. Would you really stick with it? Most investors wouldn't, and that's why tilting is so difficult. Because if you bail at the wrong time, you risk missing the rebound that delivers the premium. Think of it like litigation. A trial can drag on for years with setbacks and appeals. If you walk out halfway through, you never give your case a chance to be decided. Investing in small cap value is the same way. Look, this isn't about chasing quick wins. This is about patience, measured in decades. Volatility and uncertainty is the price of entry, not a guarantee of reward. So, how does all of this fit into the financial plan of a lawyer or any other high earner? The truth is that it depends on your priorities, your time, and your tolerance for risk. One practical step is the core satellite strategy. Keep the bulk of your portfolio, say 80 or 90%, in a simple core like a total market index fund or a combination of index funds. Then add a smaller satellite slice, perhaps 10 or 20% in a small cap value fund. That way, you get the simplicity of a broad fund with the potential boost of a tilt. Placement matters too. Since small cap value funds can be less tax efficient, many investors prefer to hold them inside IRAs or 401ks instead of a taxable brokerage account. And stress test your plan. What if small cap value underperforms for the next 10 or 15 years? Would you keep holding it or would you give up? If you're not sure you'd stay the course, sticking with the S&P 500, a US total stock market index fund, or other core holdings instead may bring you more peace of mind. And let me be clear, you don't need to tilt at all. A total stock market index fund already includes small cap value in proportion to its weight. These funds are just options for investors who want to emphasize the small cap value slice. J.L. Collins and many others stick with the U.S. total stock market and never bother with a separate tilt. At the end of the day, the decision really just comes down to what fits you. If you like the idea of an added tilt and you can stay disciplined, small cap value can play a role. If you'd rather keep things simple, the total market already gives you all the diversification you probably need. Take a moment after this episode to look at your own portfolio. You may already have more exposure than you realize. So, here are the key takeaways from today's debate on small cap value. Paul Merriman says tilt for long term potential. Rick Ferri says keep it simple with a 3 or 4 fund portfolio and keep costs low. J.L. Collins says skip the tilt entirely and stick with a 1 or 2 fund portfolio. 3 respected voices, 3 different philosophies. I truly hope you found this exploration of small cap value funds to be helpful. If so, please make sure to like and subscribe on YouTube or your favorite podcast platform so you don't miss a future episode. And hey, if you think someone else would benefit from these discussions, it would be great if you could pass along a link to the podcast. In our next episode, we'll pivot from investing strategies to workplace benefits with a deep dive into 401k employer retirement plans, how they work, how to optimize them, and how they fit into your path to financial independence. And remember, financial independence isn't just a dream. Now let's go achieve it. This episode of the LawyerFI Podcast is sponsored by Family Diplomacy, a collaborative law firm. If you are facing divorce in Florida and looking for a private, humane alternative to a courtroom battle such as collaborative divorce, give us a call at 813-443-0615 or visit us at familydiplomacy.com. We accept clients in every county in Florida, and we have offices by appointment in Tampa, St. Petersburg, and Sarasota. You are not alone. We can help.
This has been the LawyerFi Podcast. Visit our website and learn more at LawyerFi.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFi is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.